Hey guys, it's Jeff Shoemaker, broker, owner of Remax Agility here in Aldie, Virginia. I'm back today with our next step in the home buying process. Today we're going to be talking about finance contingencies and appraisals. So it's going to be a good video today. It may not be that long, but it is definitely important. First thing I would say is when you've written your contract and you've made a decision whether or not you're going to have a contingency for financing an appraisal based on what you and your agent have decided to do in your offer, it will be very important for you to make sure that you're paying attention to the days. So even if you don't have a contingency, it's really important to be involved and have a lot of conversations with your loan officer. So first things first, your contract, if you have a contingency for financing, the lender that you're working with when they issued your loan letter in the process before you wrote an offer, hopefully they have gone through the process and made sure that they've collected your documents and run your scenario through some type of desktop underwriting of some sort to make sure you're a candidate for a mortgage. Allowing that all that has happened, the next thing you're going to be watching is if your closing time is 30 days or 25 days, and sometimes it could be shorter, maybe it can be longer, but if you're doing a typical transaction, your closing time is roughly 30 or so days. So you want to make sure in the first 7 or 8 days that your lender has started the process, they have ordered an appraisal, the title company has started the process to order title as well. The reason you want to make sure those things happen is that a lot of times I see lenders not wanting to start the process until you remove your home inspection contingency if you do have one. That's really not something that is a legally required step in their process. It's something that's more policy for them as a lender. Maybe they don't want to put the time and effort into your transaction if they think it's going to fall apart in home inspection. But I would really push to make sure that they go ahead and get those done. I certainly wouldn't want to wait 7, 8, 10 days into the process and then ask them to start, because there are a number of things you're going to find out in the process of getting a loan that you didn't really think about in the beginning because it wasn't something anyone made you aware of. Whether it be documents they need, letters of some type of explanation from you or an employer, or something to do with your reserves or with your down payment, things like that. So on your finance contingency, you also want to see if your loan officer needs anything from you in order to have your agent have a conversation with them about your loan. So with my buyers, I typically like to reach out to the loan officer. In the beginning, it may not be every day. It may be every other day, because I want to know that it is the file is coming along, that it's being processed. I want to have an idea of when it's going to go through underwriting in the process to make sure that if I'm going to have an issue, I want to know it sooner than later. They're going to send it through processing, and underwriters are going to review your file. They're going to look at your financial documents, bank statements, income statements, W-2s, tax returns, anything that has to do with your money. They're going to also obviously going to look at your credit, but also want to make sure that they've seen it. And have they given us an approval, and have we received conditions for closing yet? There are a lot of times these files go through that get approved under desktop underwriting, but when they go to the actual underwriter, they get rejected for some reason or another. Now, the desktop underwriting are only really as accurate or as good as the amount of data that you're putting in, and if that data is correct. A lot of times, if an LO is just cramming things in until they finally get an approval, it may not be something that is factual. And then you come out later when you have the property under contract, and as a buyer you spent some money, and all of a sudden it's rejected, or there's some conditions that have to be met that you can't meet. So find that out early in the process. Make sure you're having conversations with your loan officer. Make sure your agent as well can have conversations with the loan officer. There are questions that I'll be able to ask, having a history in the mortgage business before being in real estate, that maybe most agents won't know to ask. And a lot of times some lenders don't think I'll ask, or things that are kind of unknown to them. So we'll go through that process. On the appraisal, appraisals come in short every day. And even though all the comps in the neighborhood look great, if the market's having some type of adverse change, or you've had multiple offers and gone above list, you may not appraise. And if you don't appraise, and the seller is not willing to reduce what it is they're asking, or what they've agreed to in a contract rather, then either the buyer has to come up with more money, or the deal's going to fall apart. So based on the amount of days you have for appraisal, in Virginia, we have a couple different options when it comes to finance contingencies and appraisals. Primarily in the finance part of the contingency, there are contingencies that will run until removed. So the seller has to give written notice to ask the buyer to remove their contingency. There are a couple options here. That's the first one. The second one is the agreement could be that the finance contingency actually expires automatically. That type of contingency is a little bit more risky to the buyer, but the buyer may prefer it because it makes their offer a little bit more competitive against other offers if they don't have the same type of contingency. So you need to know which one of those contingencies you're using, understand whether or not your lender is ready, if they're comfortable with removing it. I've had plenty of times with loan officers where they've told me, oh yeah, the loan's approvable, no problem, this will close early, everything will be great. And then we get into the transaction, and there's some issues or problems, and they want an extension of the closing date because they're not ready for one reason or another. And it may not always be their fault. It may be the lender's not getting back with a verification of employment soon enough, or the verification of employment, the income doesn't match the application. It could be anything like that. In those situations, if you were to go back to a loan officer and ask them, well, listen, if you can't get it approved and we ask for the extension, is the lender willing to pay for the buyer's costs for home inspection, appraisal, mortgage application in the event we can't close? Now, if the lender says no, then they're not 100% convinced that they'll close. And so this is one of those things where even when you're negotiating contracts and you're making an offer to a seller and you say, well, listen, we're going to offer you $500,000, and if it doesn't appraise and it comes in at $480,000, are you willing to lower your sale price to match our appraisal? Now, if they say no, and the comps all look like $480,000, then you have a problem. And you're really better to have all these communications and negotiations. These also include talking to the lender as well, because people say a lot of things and talk is cheap. But if they have to put their money where their mouth is, then a lot of times their confidence is kind of eroded away, and they're not willing to commit. I've had situations where I have put in contracts that if we've had multiple conversations and negotiation, and as a buyer, we're looking at comps and we're saying, well, listen, there's no way this property is going to appraise based on the comps. Now, we may pull a Hail Mary and pull it off, and an appraiser really likes it and gives us some adjustments that we don't see, and we're not appraisers and we could be wrong. But what I will say is, if you were to put in the contract that the seller will pay the buyer's cost of inspection, mortgage application, and appraisal if they don't lower the price to the appraisal value to continue the process to purchase. If the seller says, hell no, no way, then that means the seller also already knows that they're above the comp range. And so those are questions you have to have and you have to ask, because you have to know what the risk is, and we always try to mitigate risk and be risk adverse to our buyers, because in the end they're the ones that lose some money. In this market, we're looking at probably at some time in the future some type of correction. We don't know how wide and how deep, but while we're working these transactions, there's a very good possibility that the market value of that property could go down during the process of trying to close. And if these aren't things we have conversations about and are very transparent from the very beginning, and there's really a understanding between the parties, then we're putting ourselves into some type of positions where ultimately the deal dies. And now, in a market that's going down, it's going to affect the seller more than it's going to affect the buyer, because if everything's going down in value and the buyer decides not to take that deal and not to lower their price, and then 60 days later they finally get another offer, that offer's less because the market's gone down and they have to pay some additional cost, plus all the carrying costs, because there's clearly an opportunity cost associated with having your property on the MLS. If your house is listed and you're paying for mortgage payments, interest, utilities, taxes, you're also at risk that you could have a storm that damages the house and a number of different things. And you can calculate out how much money every day the seller's actually spending to have it setting and not closing. So if the market's going down and the trend is going down, then the seller, if they don't take that offer, and it takes them another 60, 70, 100 days, and maybe 2 more agents before they finally come to some type of arrangement to contract to close, they're going to lose a lot of money. And in a down market, the seller's at more risk. Now, in an aggressive market where everything's going up every month and things are going up on every closing, then the risk is really more with the buyer. So our market's shifting, and so some of those things are shifting as well, so we have to shift our strategy. Now, a lot of those things are extremely localized. I mean, there are places all over the country that are on fire, and they're still going up every week. There are places that they're going down. Most of you, if you've been reading the news and looked on CNN, here in the last week there was an article about properties in the Hamptons selling for some massive discounts. That has something to do with the amount of tax write-offs and things that those homes have based on their mortgage amount. Some of that's the market and the economy as well. For the last week or so, we've seen the Dow go up and down like crazy. We've seen the yield curve really get worse. A 3 or 6 month Treasury bond is basically the same price, or sorry, take that back, is paying more money than a 10-year, and so that's a little scary because that means that if you look at what their risk profiles are, they feel like a short-term Treasury note is better than a long-term, and that tells you the economy is probably going to have a change. I'm not an economist or someone that plays in the stock market, but living through the last recession, being in REO foreclosure work, doing that as an agent and paying attention to things as a loan officer and being in the mortgage business before, I can tell you that we're up for a change. And so some things are going to change in our market, and we'll be able to see different things happen, and that's a good thing. It'll be kind of a reset, but we'll have to see what happens. But knowing the process for removing your contingencies and knowing how your deal's coming along, working with your lender, dealing with appraisals is really part of the process that a lot of people don't think about until they're in the middle of it. And you need to kind of be prepared. Most of the time, agents really can't have any conversations with appraisers. Typically, I have in the rare occurrence have had appraisers ask me for comparables because they're trying to get to a number and they're having a hard time finding comps, and that happens sometimes. You'll have a house where there's nothing clear cut. You'll have a home in a neighborhood that's 7,000 square feet and everything else in the neighborhood's 3,500 square feet, and trying to get that appraisal done and to come in at value is really tough because there's nothing for them to really compare it to, and they're going to have to make everything have 10 different sets of adjustments to get to a number. I mean, technically, I guess you could compare any home to a ham sandwich and you could make enough adjustments to get the values right, but in the end, if you're not using homes that a lender will accept as comps on an appraisal, then they may just reject the appraisal under their quality control desk review for that appraisal. So, those things are not things you can always control, but if you know about them in advance and you're focusing on what's happening in the transaction and you're really having an open line of communications with your lender, with your title company, and with the other party, hopefully most of these things you can kind of mitigate, keep everybody happy, and keep things moving forward, because in the end, you got to keep pushing things forward. So on appraisal and finance, have a strategy. Make sure you know what your offer says, because a lot of times people don't know what it actually says, and they'll get into the process and realize that they can't renegotiate or that something expires automatically and they lose the contingency. So stay up on the contract and actually read it. That's probably my last tip would be whatever you sign, actually read and know what it is that you've actually agreed to. But having said that, look out for our next step in the process, which is going to be mainly more of the walkthroughs and closing activity and the things that you're going to do at the end of the process and trying to wrap up your closing and go to closing and purchase, and then obviously dealing with your move-in and getting possession of the property. So we're going to go over that as well, and we hope you like the video. If you like these videos, please, at the bottom, click like. If you'd like to see more of our videos, also hit the subscribe button, and look out for us for the next video. Hope you're having a good week.